Hello, I'm Vadani Aryam. This video is about management accounts. How do management accounts help in business? Purpose of management accounts. The information from management accounts informs how each part of the business has been performing and thereby guide decision making to benefit the company's future performance, measure the gross profit, gross margin percentage. What are management accounts? Everybody has heard of management accounts. So every day, everybody knows what they are, but that's not true. It is just the opposite. But let's start with some explanation. Management accounts are final reports produced for the business owners and managers, generally monthly or quarterly, typically a profit and loss and a balance sheet. They are like year-end accounts, but are less formal and personalized to user requirements. Why do few businesses have management accounts? There's a mixture, there's some reasons, lack of interest, never properly considered. They think the business is too small, just never started, no formal accounting system, perceived as if they think is unnecessary, unaffordable, and too busy to do this. It is fair to say some businesses will be genuinely too small or too simple to require detailed management accounts. However, they will still benefit from at least a basic quarterly summary of some sort and comparison with previous periods. It's a matter of opinion, but arguably turnover of £100,000 is not too small to benefit from some detail. What do most businesses do? And the result? The norm is that no management accounts are produced and never have been. Most businesses have insufficient systems in place to know the actual financial performance. If they did, they would have a starting point rather than just assumptions that are often wrong. Typically, a business measures its sales, knows its order book, and might have an idea of the bank situation, but that's about all. It doesn't mean it doesn't know its profitability or lack of it. It doesn't know which parts of the business are better than the others. It just guesses and or perhaps not even that. It doesn't know its overhead cost and doesn't compare performance month to month with previous years. In short, it is sort of even financial information, enough financial information. Some businesses worry about this, others don't, but it stands reason and then if it is measured, it can be improved. That is what it's all about, the bottom line net profit. The result is that the business underachieves profit or is taken by surprise because difficult circumstances can arise without warning, sabotage, shortage of cash and liquidity. Most companies make financial decisions in the dark, which isn't a good thing. Without sound financial information, the business is at risk of significant or severe underachievement in profit or cash. Another critical effect of no accounts is a risk of overtrading, expanding sales too quickly so that the company runs out of cash or working capital. In short, customers may not have paid before, suppliers and staff demand their money. It is a principal reason, that is one of the main reasons for the businesses to lose. It becomes a huge surprise for the business owners. Accurate financial information would highlight this is happening so that they could have taken action in advance. Even if they prepare management accounts, they may fail to have vital information. It is a company has many, if a company has many projects, the problem is that they will not have enough information about each project or to compare each project's performance. Hence, the company had no idea of the profitability and lacked any financial control of individual projects. Suppose you are serious about improving your profitability. In that case, naturally, you will ensure that you receive prompt every month the critical and non-financial information you need to run your business effectively and efficiently. Some issues are apparent and easy to identify, such as just no management accounts, or they are far too late or of poor quality. Personal users' difficulties around the table tend not to be obvious or even admitted. These broadly fall into two categories. The first is lack of understanding of the numbers and what the action to take. The second is accepting substandard form of reporting, perhaps assuming, probably wrongly, that it can't change or that would be too expensive. A short reporting situation is a shame, but it's worse. It potentially costs serious money if management decisions are being delayed or prevented because of the lack of quality management information. Be cautious. It is not a good idea to carry on with a detailed reporting you inherit without reviewing whether it fits your purpose. Circumstances may have changed over time, so the reporting needs adjusting, but this won't happen automatically. Of course, this applies equally to charities, where arguably it even more critical to have the management information and understand it, as trustees are personally responsible. There are different businesses with different margins. If mixed in one, while you can still tell the sales performance, you don't know which is improving its margin profitability and which is not. There is no way of speaking. Perhaps the most challenging obstacle to overcome is for a user to admit a lack of understanding to a certain extent that is down to the service provider checking, asking, hinting, or otherwise, but it's mostly down to the individual getting real. I hope you understood the concept in this video. Thank you very much for watching this video. Thank you. If you like it, please share it and subscribe to my channel as well. Thank you very much for watching. Bye for now. See you in another video. Thank you.